Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora, welcome back to another episode of Markets, Mystics and Mayhem. It's around that time of year where Team Eco pairs up with Team Financial Markets at Kiwibank to put out our latest FX tactical. So we've recently put out our latest views on the currency, and today's episode we're really going to delve into what we see going forward for the New Zealand dollar. We've got the none other but Mieneke on the podcast today. No one better to have than Mieneke. She's one of the traders here at Kiwibank. So we're going to really delve into where we see the New Zealand dollar against the US dollar. Very, very topical story right now. But also the other sort of key Kiwi currency pairs. So Mieneke, the last time we sort of did a review on the Kiwi dollar and the FX tactical in general, we were saying that the Kiwi dollar had more pressure to come under. We said we saw it heading to 57 cents, maybe even 55 cents. This was back in December. So what's happened in that space since?
Well, we were right. The Kiwi got down to the low 55s. It was a relatively brief move lower. But what we saw was a bout of risk aversion on the back of Trump 2.0. This has been driven primarily by Trump's tariffs and all of the uncertainty, the toing and froing around that. So we've just seen risk off the table, and the Kiwi ended up heading into those low 55s. We've since had a bit of a recovery, however. And that is as the worm has turned, if you will, on the US dollar. So people are starting to question, the impacts on the US economy itself, not just on the global economy. And they've got concerns around growth slowing right down in the US and globally. It's the kind of mess that they could be making of their own economy by introducing these tariffs, I guess.
And it's so interesting to see how investor sentiment has really shifted. Like if you think about end of last year, there was, I think we had Mike Taylor on the podcast a few weeks ago, and he said there's a sort of euphoric end to 2024. You had a new, Trump administration spouting pro-US growth, and you saw equities really rise. But there's been this big risk aversion trade, hasn't it? This sort of flight to safety, and the Kiwis obviously not held up as well.
That's right. So, in this kind of environment, the Kiwi generally does struggle as it's the kind of currency that you hold if you are risk positive, I guess. And we've actually seen that happen again overnight. So we're now getting into April 2, which is the date of when Trump is going to be announcing some of the details around the tariffs. And the Kiwi has actually fallen below 57 cents again. So we have had a wee bit of a recovery, but it's a jittery one, to say the least.
Yeah, and it's interesting because you've got all this tariff volatility, but then underlying that as well, you've also got the interest rate differentials, which have been underpinning the Kiwi dollar for much of last year and continues to, putting the tariff story aside, if we look at before all of this mess, we still saw the Kiwi economy underperforming and the US economy performing quite well. And so there was already that interest rate differential building, but that's just exacerbated the move, right?
That's right, yeah. And interest rate differentials are still in play, and we expect that will be the case over the year ahead, really. But at the moment, it's just been kind of sidelined, I guess, as a main ticket item for people in markets to watch when there's so much else to watch instead, I guess.
Yeah, and there's a lot to watch and there's a lot of unknowns right now, but where to for the Kiwi dollar from here?
We think that, the Kiwi has actually held up relatively well given the circumstances and given the risk aversion. So we've recently been trading more in the 57 or 57.50 levels. So we've got some good support at 57. Our pick for the Kiwi for this year is that we will probably, in the second half of the year as the economy picks up, we'll see the Kiwi lift on the back of that too. So initially you'd be looking at 58, 58.50, and then I don't see why, we couldn't be at 60 cents by year end. But between now and then, there's a lot of water to go under the bridge, there's a lot of mess still to be had, and a lot of unknowns to be discovered around tariffs and their impacts. And so, in the meantime, in the short term, we may see the Kiwi remain under pressure. We might even, head down to the 55 levels again. That's entirely possible. It just depends what plays out in the next couple of months.
I think that is our central view, that we see that recovery in the New Zealand dollar the second half of the year. But as we see it, the risks around that central scenario is very much to the downside, I think, especially near term, just with all the volatility that we've seen. I think markets, maybe there's a bit of fatigue with all these Trump tariffs kind of coming on and off again. But I don't think the actual scenario of a escalation in the trade war has really been fully priced in. And if that does play out, I think you'd see the Kiwi actually test that 55 cent level again, right, just on risk aversion.
Absolutely, that's not off the table at all. And you're right, I think just because of the unknowns around the tariffs, it is actually quite difficult to complete valuations, which is also why we've seen risk aversion, particularly in equities. And with that unknown, how do you measure it? Where can it go? Perhaps, the Kiwi might already be into those below 55s at this point, if it had been fully priced in.
Yeah, exactly. And then as well with the risk aversion, obviously we've seen the US dollar. Has it been favoured in this risk aversion kind of scenario?
Ordinarily, the US dollar would be favoured, as it's liquid. It's always chosen by people, kind of like gold, in a risk averse scenario. But what we're seeing is, as people start to question the impacts of tariffs on the US economy, on whether or not they'll see reinflation on the back of that, people are just very wary of the US economy a little bit, I think. And so it's actually started to fall, the US dollar. And this has also been driven as well by the euro, which has had a bit of a resurgence, which we can cover off in a bit more detail. But yeah, as we know, the .dxy, or the US dollar index, the euro makes up the largest portion of that basket. And so when we see the euro have a bit of a lift, that's going to keep a lid on the US dollar. It's kind of got that push-pull, reaction. So yeah, I think that we'll probably continue to see the euro have a bit of strength. So that's going to keep a dampener on the US dollar. And again, the mess from tariffs and uncertainty is going to keep being a theme, I think. And it could be some time before that turns.
Yeah.
And I think that's a little fun part about trading currencies, because it's not just purely New Zealand dollar, Kiwi dollar. You have to look at how that relates to another currency, and all of that goes. So it's a pretty complicated job, Mieneke.
Yeah, you do well. I think we should go into about the Kiwi-Euro a bit more, because, as you said, it's definitely been one that's kind of popped up on everyone's radar, because no one was really expecting it to really pop that leg higher. But as you said, people have sort of been moving away from the US dollar. There's also some increased government spending in the euro. So we have seen that lift higher. Do you see that being sustained, or where to from here?
I think for now there's every chance that it is sustained, and definitely in the short term. So what we've seen is Germany has come out with a huge spending package for infrastructure and defence spending. If that's going to continue going ahead, so that's only probably going to get some more momentum. And also how the Eurozone and sort of more individual countries come together and around defence spending and planning will also be interesting to see. We've also seen European equities be favoured over US equities to a point, as we've had issues with valuation. So with the unknowns with tariffs, of course, it's hard to know the impacts, and therefore it's hard to measure the valuations on equity markets. And looking at growth forecasts looking quite low, we've seen everyone's sort of sees the US equities as a little bit overpriced, especially your big tech stocks like your mega caps, your Tesla, your Meta shares. Those kind of investments have been unfavoured or have become more volatile. And so people are going and looking for alternative markets to invest their money in. The Eurozone is one of them. So those equities were seen as potentially a bargain compared with US. So that theme may continue, probably more than likely. And yeah, I just don't see much downside for the euro at this point. Of course, there's a caveat to that, and we've got geopolitics to consider, which is a big issue. So yeah, that can always turn at any point in time, as can any currency, really.
Yeah, it's at pivoting away from the US. It's been hard to look at your Sharesies account with
Don't even tell me about it, seriously.
But yeah, it's that move away from the US, just with the growing fears around a recession, potentially even stagflation over there. So, and that Germany news was really big. I don't think they've had that big of a planned increase in their spending on defence in a long time, right?
It's been quite a long time, I think, yeah.
Yeah, so that obviously gave the euro a bit of strength there as well. And interest rates, if we talk about European central banks, Sabrina, what is the ECB doing?
Yeah, I mean, much like everyone else, central banks globally have just really taken a cautionary approach. I think we've definitely reached a point where, cuts were coming in the cutting cycle, but now it's sort of the delivery of further cuts is definitely data dependent, as it always has been, but really data dependent and cautious of what is happening. But I think the pace is definitely slowing now for rate cuts, particularly in the Eurozone. So I think, that will sort of see the interest rate differential mechanics kind of continuing there.
Working against the Kiwi, right?
Working against the Kiwi, yes. Whereas here, we, the Reserve Bank has a very clear, unlike other central banks that are sort of starting to slow down and maybe have to think about the path of rate cutting from here a bit more. I think the Reserve Bank's policy stance is almost set in stone. Like conditions domestically are pretty much perfect for them to deliver the 2 25 basis point rate cuts that they've signalled in their February track, and potentially that extra third 25 basis point cut that we forecast them delivering in September. So the path is pretty clear for the Reserve Bank. The New Zealand economy definitely needs that rate relief. So in comparison with the Eurozone, that interest rate differential will see it working in favour for the Kiwi dollar.
So yes, there's a bit of downside, but it seems like the global backdrop is really the main driver for currencies, whether that's the US dollar or other ones, right?
That is definitely the theme at the moment. We don't see a lot of reaction when we get local data at the moment. There is some, particularly around consumer confidence numbers. That seems to be quite a theme globally as well. And US consumer confidence is slipping, and our own consumer confidence is slipping as well. And a lot of this is driven by that global uncertainty, and global growth is looking, very questionable at this point. So, yeah, I think that those themes are definitely going to stay for now.
Yeah.
Goes across all the currency pairs, really.
Yeah.
Okay, I guess moving on to another currency pair. What about the Kiwi-Pound? What are we seeing there?
Kiwi-Pound has not done a lot, really. It's been similar to the Kiwi-Euro.
Kiwi-Euro, okay.
Similar-ish to Kiwi-Euro. But, the UK's got a slightly different problem as well, right? They have had some surprisingly good data over the last couple of months in particular. But, Kiwi-Pound we consider will probably just sort of remain range-bound for now.
Yeah. And I think, interestingly, in the FX tactical, we do get a little bit technical at times, and fundamentals like interest rates and economic growth are a big driver of currency, but so are technical levels and such. And one thing we look at is the relative strength index, right? The RSI. And that is, I see it's, first of all, why don't you explain what that is to people?
The RSI is a relative strength indicator, and it's usually used in conjunction with other technical analysis and charts, etc., to sort of look at whether or not something is maybe overbought or oversold. It's basically looking at that cross over time, and the RSI can be useful to give you an indication about whether or not a currency might continue to move in a certain direction. So I think in our FX Tactical we talked more around the Kiwi-Pound maybe being a little bit oversold. So we might get some support on the back of that.
but otherwise kind of same as what we probably wrote last time, right?
Pretty much.
Which, in that case, moving on to the Kiwi-Aussie, is it still like watching paint dry?
It is a little bit. It has had a little bit of movement lately, but again, quite range bound. I would give it 89.50 through to say 91.50, and it could stay in that range for literally months. Of late, we have actually had a bit of a dip below 91, and that was on the back of we've had the Aussie economy has had. It has had a few woes, I guess. We've had they had a lighter CPI print than expected, but they still have a Reserve Bank that's not very willing to continue to cut rates further. I think they gave what I would call a very hawkish cut at their last meeting.
So are we still surprised then that we haven't seen the Kiwi-Aussie move lower, in the sense that, you know, we've been cutting, the Reserve Bank here has been cutting quite aggressively. The RBA's only just started, and even then they're pretty reluctant to cut and aren't really, you know, picking up the pace of their rate cuts. So are we still surprised that we haven't seen sort of the Kiwi-Aussie kind of break lower?
Yes and no.
Because it's been such a long time?
Yes, that's right. And also I think with everything going on in the world and also looking at China in particular, I think the Aussie economy is just a little bit more exposed to some risks, or at least the perception is that the Aussie is, you know, exposed to risks a little bit more. So that's kind of keeping a lid on the Aussie dollar. And so therefore Kiwi-Aussie is not really moving around that much and is clinging pretty close to that 90 level. We've kind of changed our tune a little bit on the Kiwi-Aussie cross moving lower. I think that we'd need to see some strong kind of stimulus in the Chinese economy in particular to kind of give the Aussie that boost. And we are seeing it, but it needs to be kind of sustained over a longer period of time. And with what we've got going on with uncertainty and, of course, China being a main target for Trump and tariffs, that's probably not going to be on the cards for another couple of months.
And I guess with the Reserve Bank of Australia coming in, I know they seem reluctant to do, you know, back-to-back cuts, but I think markets are still pricing in more rate cuts from the RBA this year. And that, I think, with them coming in and obviously the Reserve Bank kind of closing, nearing their end of the cutting cycle, that interest rate differential isn't quite as, it's not working against the cross as much as we did, you know, 3 months ago thinking.
That's right. I think a lot of the focus has been kind of dragged away from interest rate differentials in the current environment. But that's not to say that they're not important and that they won't necessarily become more of a focus for market participants in the coming months as well.
Yeah, especially if we move out of, hopefully, this volatile period that we're in. Okay, well, not quite the last currency pair, but last major currency pair for, you know, I think this is quite a popular one at the moment with a lot of Kiwis travelling over to Japan. What's happening in the Kiwi-Yen space?
Kiwi-Yen has had a bit of fluctuation between, say, 82.50 up to 85.50 at the moment. I should double check that actually. But, you know, the yen is a bit of they're in a different place to the rest of the G10 in Japan. So they're actually looking at increasing interest rates off a very low base for a very long time. So it's not really surprising, but they are taking their time to do so. And Kiwi-Yen has also been affected by, you know, the carry trade unwind in recent months. So that was something that we were talking about a lot about 3 or 4 months ago. That's sort of not the main theme anymore. But, yeah, Kiwi-Yen, I would say there's probably some downside there, especially on the interest rate differentials.
Well covered. We have a little tradition that we've kind of made up on these FX tactical podcast episodes because we've had Wilkie come on the last one. Now we've got you. Last time we asked Wilkie to tell us about the Mexican peso, not one that we actually covered in our research, but we thought let's just throw him one. So, Mieneke, I'm going to throw you one. You've got a Polish background, right?
I do.
So what's happening with am I correct? Am I pronouncing this correctly? Zloty?
I believe it's zloty, although I don't actually know how to say it because I don't speak Polish and am Kiwi as actually. But I do know that the ticker code is PLN.
Awesome. We'll take a look.
Is that it?
Yeah, that's all I have to say.
Okay, we'll have to take a look after this one.
Yeah, we'll go back and have a look at our Bloomberg and see what
PLN.
it has to say.
All right, good to know. Great. Well, I think we've covered all the major currency pairs and some extras. Thank you so much, Mieneke, for coming on. It's really great to have an expert like yourself to talk through all the dynamics of the currency. You know, it's a very volatile time right now for any currency pair, but I think, you know, we are seeing green shoots in the Kiwi economy, and those green shoots in the recovery domestically should see the New Zealand dollar, you know, edge higher in the second half of this year. You know, right now we're still kind of range bound, but should things go towards our central outlook, then, you know, we'll see the Kiwi dollar in the year higher, and hopefully we won't see things go to the downside.
Hopefully not.
As always, be sure to like, follow and subscribe, and we'll catch you next week. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insight.